We just have a quick question here from Sharia asking whether there is a correlation between the ADR and pivot point. So as always, thanks for the question, Sharia. So looking at the ADR and the pivot points, both of them at their most basic level actually shows us the same thing. So just at different intervals. So in that sense, they do have a correlation with each other. And both of them are basically designed to show us average volatility, but based on a slightly different calculation in terms of the math, but showing us the average volatility for a particular asset over a specified time horizon. So the biggest difference between them for me is just the difference in volatility as it's measured by the different time horizons. So for example, the pivot points I'm using, let me just quickly open this one up, is just the classic pivot point that's calculated on the daily. So that means it shows us the average volatility for this particular instrument based on the last day's price action, and gives us an average of the open, the high, and the low of the prior day. And that normally gives us the central pivot point or the daily pivot point. And also then based on a different calculation, it also gives us possible support and resistance levels marked out as S1, S2, or R1, R2, etc. Also based on the prior day's movements. Now, if we compare that to something like the ADR, let's just open up the ADR. So if we compare that to something like the ADR, that is usually set at a higher interval. So you can do anything from 2 weeks, which is normally two trading weeks will be 10 trading days. You can set your perimeter at 10, or sometimes also set it at 21, which gives us a rough estimate of the month's trading days. So normally 21 trading days roughly would be a month's worth of volatility. So you can either set that at 2 weeks or 3 weeks or 4 weeks, 10 or 15 or 21 trading days. And that basically gives you the same, it shows you the same thing in that sense, but it is calculated slightly differently and obviously used, as we said, at with a slightly higher time frame. So think of the one being a lot more sensitive to the immediate term, and the other giving you a bigger picture view of the average volatility over a slightly larger period. So as an example, if we change the ADR's value to, let's say, just a look back of 1, we should see it coming in very close to the R1 and the S1 pivots. Now, based on, of course, the way they calculate it, they will be slightly different in terms of price action. So it's not always going to come in exactly on the S1 and the R2 or the S1 and the R1. Let's just do another example, because it will be calculated slightly differently, but it should be fairly close. So here we can see, that S1 coming in right on top of the ADR low, but we do have a little bit of a gap there between the R1 as well as the high. So there is a slight difference still, but by reducing that ADR level, down to 1, it should give you, just a little bit of an idea of that they actually do show you the same thing, but just on a different time scale. Now, the only downside with something like the pivot points is that it is calculated based on the prior day's movement. So if you have a previous day that was very, very quiet, a very quiet session, you will have a very tight range the next day, right? Which means that if you have a very big market moving event today, for example, you will easily slice through the first support and the resistance points, and might even reach the second or the third pivot levels for that particular day in a very extreme environment. And the vice versa is also true. If the prior day was a very big mover, you'll have a wide range for the pivots the next day, which means that you might not even reach a pivot, in terms of the S1 or the S2, the S1 or the R1 for that particular session. So that's why combining the two of them is very useful for me, because it gives me a slightly different way of looking at the expected volatility for that particular asset. So, if I had that big volatile move yesterday, I might see the pivot points reach far outside the ADR high and low, but then of course I can use the ADR high and low as a better gauge for that particular session in terms of possible levels. The other thing I like about both of them is that there's no subjectivity with them. I don't do the calculations myself. It's done for me, which means I can basically just focus on adding my other tools on top of that, like normal support and resistance and psychological price levels, etc., to find those very high probability areas. So I hope that helps, Sharia. As always, if there's any other questions, please don't hesitate to let us know.